Hello and welcome to our special pre-budget series, What the World Wants from India. We've been getting you a string of top-notch global investors to understand what they want from the budget, what might put them off, and whether India still remains attractive as an investment destination. Today our guest is Lucy Macdonald, the Chief Investment Officer at Allianz Global Investors. Thereafter, we will also be speaking with Robert Marshall-Lee, the head of Emerging and Asian Equities at Newton Investment Management, an arm of BNY Mellon. But first, let us invite Lucy Macdonald of Allianz Global Investors. Lucy, thank you very much for joining us. First, let me clear some near-term worries. India has been an underperformer months to date vis-a-vis other emerging and Asian markets. Is India losing its ranking among the emerging markets basket itself?
Yes, I think many of the global investors and the regional investors have lost some of their enthusiasm for the speed of reform in India. And that has caused some outflows from the country. And I think some of those outflows have gone towards Indonesia this year, hence the outperformance of that country. So I think there's a lot of real focus on how that reform goes, how the sales tax moves through the upper house in particular. There's a lot of focus on that. But at the same time, I think it's quite healthy that the expectations have come down a bit, because the expectations were probably a little bit unrealistic and too optimistic towards the end of last year about India. So I think it's quite healthy that the valuations have come down to a more normalised level.
Okay. Time permitting, I'll come back to this earnings and valuations question. First up, the most important policy statement from the Indian government is the budget, and that's just a few days away. What are you expecting from the budget?
Well, at the moment, our expectations are not particularly specific. It's much more looking and seeing the path of reform as we go through the next year. And in particular, as I say, watching to see how that sales tax gets through the upper house.
Okay. Well, there are murmurs that the short-term capital gains tax will be expanded to not just 1 year, but 3 years. In other words, equity investments could get taxed a bit more than they are currently. Will that be a major negative for you? All
taxation is on the margin important to us. So yes, it's on the margin, but I think really we're much more interested in those big issues of freeing up infrastructure, making foreign investment easier into the country, and allowing easier flow of goods and services around the country. Those are the real major things. On the margin, what's happening to taxation is interesting, but it's not the most important thing in the medium term.
Would the fiscal deficit be a very important number that you would watch out for? The government ought to have reached 3.5% of GDP as the fiscal deficit target last year. They pushed it to this year. If it's not achieved in the 2016 budget, would it be a disappointment, that 3.5% number?
No, it's not a particularly distressing number when you look at it in global terms, and when you look at some of the deficits that we're surrounded by in Europe or even in the US. Fiscal deficit of that size is not alarming, but at the same time you do like to see the control. Now, I think one thing that we have been very encouraged by as other investors has been seeing stronger control of the fiscal situation, and also monetary control within India. So we do want to make sure that is maintained, and that credibility is maintained as an overseas investor.
Okay. When you say the monetary control is maintained, you would want the Reserve Bank to pursue its inflation targeting? Is that what you're expecting?
Yes, because there is an inflationary bias within India, which has been under much better control recently. So you want to make sure that is maintained. Speaking from the UK, which also has an inflationary bias, we need strong monetary management.
Well, to come back to the earnings issue, we've been waiting for earnings to reach double digits for practically the past 2 years. Every time we push it by about a quarter or two down. How disappointment was the recent earnings season?
Well, it has been disappointing. However, when you look at it in a global context, there's been disappointment really widespread, and India is only marginally worse than average. So you've seen a disappointment throughout the earnings season in the US. Not huge, but on the margin, there have been misses at the revenue level, and you've seen that in India too, that revenue has been slightly disappointing. However, the corporate sector has been very strong globally at keeping its margins quite strong, and that's also been the case in India. So you've seen the EBITDA missing less than revenue, so that means sort of good margin control. That's, I think, what we expect to see, that it's still going to be very difficult for corporates to grow at the top line as you see decelerating nominal growth around the world.
Well, as you say, revenue growth is going to be difficult at a time when commodity prices are falling and there is a general problem with producer prices everywhere. So would you be okay with a growth in margins and earnings? What are your earnings expectations for FY17 itself?
Well, overall, our global expectations are for mid-single-digit earnings growth, and that really is at best. It's certainly, as far as top-line growth is concerned, making a mid-single-digit is going to be very hard work in the current environment. And so if the companies can hold their margins and make a similar level at the bottom line, they will be doing a good job. So it's going to be a continued low-growth environment. We've been really anticipating that this low-growth environment is going to be the medium-term norm because of the levels of debt in the system and because of the levels of uncertainty about some major factors. We've seen a big recovery in corporate earnings since the financial crisis. That is now levelling out. We've seen a huge stimulus of monetary stimulus, which is now coming to an end in the US, and the US is obviously the most important area for that. So it's just more difficult for any companies to generate top-line growth. So those who do, we do think will maintain a decent valuation premium.
Okay. What's your sense, therefore, in terms of India's pecking order in global equity markets? Where does it rank within emerging markets and within your favorite markets?
Well, it's been derated, but it's still on the more expensive side. If you look at the adjusted PEs around the world, India is still at around 18 times, something on the high side globally and also within emerging markets. So I think it still looks a bit expensive, but at the same time, the earnings, as I said, have been disappointing, but there are worse around. So I would say it's pretty mid-range when you're looking at from a growth and evaluation perspective in a global and an emerging context. Now, what is interesting about India, though, is that it does have some of its own internally generated potential, and that in an environment where growth is very scarce, to find an area which has got the potential for expanding growth through supply-side reform, that is interesting. So we are favourably inclined towards India, particularly as we've seen this relative derating and some of the excitement about reform coming out of the valuation. So I think we're more positively inclined to India now, having seen that.
Okay. Do you see yourself getting, pulling India up in your pecking order before the year is out?
I think we are inclined that way, yes. So looking for opportunities there, and we have been looking at several areas recently. So the only issue is that some of the stocks which are attractive and available to international investors tend to be on the more expensive side. So seeing more valuation opportunity there would be good.
Okay. Lucy, what exactly are you invested in India, and where will you where will you put your incremental money?
Well, we tend to be at the moment in the consumer and healthcare names, and some at IT. Mm-hmm. Where we're looking to become more enthusiastic is in some of the more infrastructure type names, and that is, as we see some stabilisation and potential for recovery there, those would be the areas of interest to us.
All right, Lucy, we'll leave it at that. Thank you very much for joining us today.
Not at all.
We need to take a break. Thereafter, Robert Marshall-Lee of Newton Investment Management joins us.